Guys, I was hoping for a moment we might put the rate cut business to bed with this payrolls report. Maybe we haven't, Anastasia. Your take?
I think this should definitely alleviate some of the pressure that Chair Jay Powell kind of unleashed on the markets in the last couple of days, because the market has been sort of begging or starting to ask for this insurance cut. And the fact that payrolls came in so solidly just says that maybe we can look through the inflation, that it's going to slow down in the next few months, and the strength of the underlying economy is still very much there.
Rick?
I mean, I think the insurance cut idea that we need another cut or we need an insurance policy doesn't make any sense. You have nominal GDP that's running at 5%-ish. You know, we're going to trend down a little bit. But with the employment number, I mean, think about what is the Fed's mandate? It's full employment and price stability. Full employment. I mean, we are through full employment clearly, because you continue to see moderate wage pressure. It's Goldilocks for the Fed. I mean, this can't be better. And doing nothing and just stepping back is the right policy.
Is that what this is, Mike? Goldilocks?
Well, we're calling it a nirvana, right? When we poll our internal strategists and people who run our different asset classes, we say, is a high yield market rich or cheap? They say, well, it's cheap to nirvana. That's our new thing, CTN, cheap to nirvana, right? And that's a scary thing, because when nirvana is fully priced in, that's when you're supposed to be afraid. But the Fed is firmly on hold for the indefinite future, right? And right now, there's actually a 50% probability of a cut priced in this year, and almost a full cut still priced in next year.
So Mike, the question is why? Why, when we have a jobs report that shows output that's still pretty decent? I understand that the inflation pressure story is still tepid, but why is this market still set up for a rate cut?
You know, people believe it's too good to be true, maybe, and it can't last. Nirvana can't last, right? And the path of least resistance, and we've been saying this for a while, is that the funds rate, I think, at 240 is still too high structurally for the long term. On the long term, it's probably going to trend lower.
Rick?
So, man, I think there's an asymmetric dynamic that's really important. The Fed, if they raise rates, will go one more time, very slowly. They're going to wait a long time. If the economy slows, the Fed's going to start cutting fast and will get down to zero. So you have an asymmetric risk reward in interest rates, particularly the front end to the belly of the yield curve. The other is it carries really well. I mean, we're not talking about zero interest rates anymore. You can buy front end of the yield curve at depending on where you go, 230, 240. That carries really well in a portfolio, and it works as a hedge, because if the economy slows, Fed's moving quickly.
Anastasia?
Yeah, I want to get back to your question about why is the market actually still pricing in almost 50 basis points of cuts between now and end of 2020. I think it is mispricing, by the way, and I think it's happening for a couple of reasons. Most people out there are still talking about the notion of late cycle and when is this cycle going to end. And the reality is the Fed has likely extended the cycle. They've had a pause that refreshes. It gives the economy some runway here. So that's the narrative that I think we have to set aside for a little bit. And the other issue is the average inflation targeting, which is a concept that the market started to discuss. And now that they're saying, because we're going to see core PCE prints actually hit 1.5% in the next couple of months, that's what the rationale is why the Fed should be cutting. But again, the Fed is going to view this as transitory.
Let's bring in Michael Gapen, shall we? Barclays chief U.S. economist. He joins us from the trading floor of Barclays here in New York. Mike, always great to catch up with you. Walk me through your take first, and I want to get to this rate cut debate in a moment.
Yeah, so I would agree with everything that's been said, and I'm going to just cast it in a slightly bigger picture, right? We had a jobs situation that looks good. We're looking at Q1 data where growth was strong, but the composition was poor, right? Over half of growth coming from trade and inventories. So we're looking at this March and April data flow, trying to peg whether or not things are slowing or we're going to get a rebound. This number fits squarely into the camp of domestic demand's going to rebound. The recovery does look like it has legs to it. So it's a very complementary report with everything else we're seeing. I'll push back on the wage number just quickly. Yes, it was a little weak at the headline, but the production and non-supervisory component, which over time should be tied to the cyclical performance of the economy, that was up 0.3 on the month and 3.4 year on year. So I still think it's consistent with gradual building of wage pressures. I wouldn't discount that number entirely.